Before you get a HELOC and take money, make sure that you know how it impacts your credit score. Hey guys, I'm Duncan. I've been in the mortgage industry since 2001 and I've worked every position, including being an owner. So I've seen thousands of credit reports. In this video, we're gonna go over how a balance on a HELOC may impact that credit score. So please share if you know somebody that's getting a HELOC and they can benefit from watching this video, please make sure to share it to them. And also if you can like and subscribe it so others can see it, that would be great as well. HELOCs have become really popular these days, so people have a ton of equity and they don't necessarily want to touch their first mortgage. They may have got an interest rate in the 2s last year, and so they're thinking, okay, I want to get some cash, but I don't want to touch that rate that's in the 2s. So getting a HELOC can be an attractive option. It does carry lower closing costs than a traditional mortgage, and the payment's usually pretty low because it's interest only, and it's kind of like a use as you need option. Just as you need some money, you can use it, or if you don't, you can leave it there at a zero balance. So here's the problem. You know how on a credit card, as the balance increases, the score starts to decrease? Well, credit bureaus treat this similar to a credit card. So that's right. Let's say you take out $50,000 for some home improvements. You're really excited for this adventure you're gonna go on with upgrading your home. So you go on this shopping spree and you spend all the money buying everything that you want. So the statement comes in the mail and the statement balance is $50,000 and you begin your low payment. Next time you have your credit pulled, your score plunges. It's kind of like having a maxed out credit card. This is because how the credit score treats revolving credit. You see, when someone gets into financial trouble, the first thing that happens is the credit card balance goes up. Credit bureaus are aware of this and they factor it into this credit score calculation. So over time, as that credit card balance goes up, then it hits the max, and then what we have after that typically is a missed payment. So that's the typical trend when somebody's going into financial trouble. So credit bureaus being aware of that, they're tracking the balances on the credit cards, and as those go up, the credit score goes down. So same thing here with the home equity lines of credit. Now the funny thing is if you look on the credit bureau website, it specifically says that the score excludes HELOCs from revolving credit utilization calculations. That's not my experience. I once used one of these to fund a short-term investment and my score dropped over 50 points. That was the only change in the credit bureau at that time. I've seen many credit reports with this same issue, okay? So HELOCs can be a great tool if used properly, but you have to make sure that you know exactly how they work, and it's also a good idea to know any other options that you may have. Go ahead and watch this video right here. We'll see you on the next one.